I'm 21 years old and I've already made over $1 million from trading. Now, this isn't to flex. I'm saying this to show you what is possible if you stop doing what is holding most traders back. So over the next 15 minutes, I'm going to share the exact lessons that helped me reach this point so you can avoid the years of mistakes that I had to go through. So make sure you watch the whole way through so you'll see the process of me losing money in my college dorm room to now becoming a millionaire just a few years later. First is to master one model, one pair, and one session. Most traders don't fail because they lack knowledge. They fail because they're overwhelmed by too much of it. You're probably jumping from concept to concept and you're looking for that best strategy. And I personally was the exact same when I started. I remember I would try a strategy for a week. If that didn't work, then I would search on YouTube for the next best strategy. And I would keep searching and searching and searching. And I would always be changing my strategy, which led to me never having consistent backtesting results. And I never knew which strategy was best for me or what worked. Because I see it all the time with beginner traders. They're first trading New York session, then they'll trade London session, and then they'll trade NASDAQ, and then they'll switch to gold because they think gold is going to give them better price action and it's going to be easier for their strategy. But if you keep doing this, your brain just never locks in. You'll have no consistency with your trading. You'll have no rhythm. You won't understand the nuances with your model or your strategy. And so you're just hindering your progression like crazy. So the simple fix is just understanding that real growth starts when you just stick to one of everything. So nowadays, I literally just trade one model, one session, in one asset. And I trade with inversion for value gaps, but that doesn't mean that you have to trade with inversion for value gaps. You just have to trade what makes sense to you and what fits best your psychology and your emotions. I then trade NASDAQ futures because I find that it aligns with my strategy the best and it gives me the best price action for my given strategy. And I trade this during New York AM session from 9:30 to 11. And that is it. I trade from 9:30 to 11 every single day. I don't trade London session. I don't trade Asia session. I don't trade PM session. I just trade those 2 hours out of the day. And if my model presents itself, then I take the trade. If it doesn't, then I don't take the trade. But if my model, for example, doesn't present itself, then I don't trade another model that, maybe I found on YouTube a couple days ago. No, I trade only my model and I trade only my session. I trade only this asset. And once you start focusing on, again, one of everything, you'll become such a better trader because your brain will start to understand all of the nuances that come with your specific model, start to understand all the nuances that come specifically with trading that session and with specifically trading that one asset, and your win rate will skyrocket. And so what happens when price action just doesn't make sense? The model is not presenting itself. Well, this brings us to lesson 2, which is if price could go either way, do not trade. This one rule alone, I swear, has saved me from so many losses. And just applying this right now could save you from years of blowing accounts and slow progress. The most common issue I see with so many beginner traders is that they force trades within chop. We might be bouncing between two significant PD rays on the higher time frames, and you might think to yourself, I don't really know where the market is going on the higher time frame, and then they'll still take the trade, even though they're not confident in any direction. I'm telling you, if you go back in your journal and you look at all the losses that you've taken, the majority of these losses will be trading within chop because this is where most accounts get blown. So after years of going through this myself, I've learned now to just simplify. If price is bouncing between two significant levels and I have no idea where the market is going, then I'll simply just wait. It's crazy how this took me so long to realize that if conditions are unclear, just simply sit out. You do not have to know where the market is moving at all times. Wait until the market is very clearly telling you its direction. There's been so many times where I'm coming into the day and I literally have no idea where the market's going to go. So what does that mean? Am I going to go now down to the lower time frame and then say, oh, I'm going to still try to find a setup and force a setup? No, I'm going to wait for the market to present me an extremely obvious setup and give me extremely obvious displacement in my direction, and then I will take that trade. Because good trades should feel obvious. They should not feel forced. You should be telling yourself, I am stupid if I don't take this trade. And just always remember to stay patient because the market will present you with that A+ setup and it's not going anywhere. Now here's one of my students, Jamar, who had this exact problem when he first joined PB. He forced a lot of setups even when he was uncertain and he just didn't know when to step away. But after learning how to actually step back and just being consistent for 2 hours every single day and just following the model, he has since made over $57,000 in just 3 payouts at 22 years old. So if you're interested in learning how to apply the concepts that I teach every single day inside of my 1% mentorship, then click the first link in the description below to get started. Now this next lesson is where the majority of ICT traders fall short. They might recognize one part of the setup, but they fail to put the full picture together. So number 3 is starting with draw on liquidity first and then your entry model. Everything revolves around draw on liquidity. It's defined as where price is going to be delivered to. But this is where most traders go wrong. They have this entry model, but they fail to actually see the true direction in the market. You just plain pattern trading, constantly flipping your buys throughout the day, and missing the actual move altogether. And I see it all the time with beginner traders. They'll hop on the charts on the lower time frame. They won't come into the day with a plan at all, and they'll see their entry model present itself. For example, they see an inversion for value gap just present itself. And what do they tell themselves? Oh, this is my inversion for value gap. This is my model. I'm going to take the trade right here. And then they get stopped out and they're like, oh, why didn't the model work out? When they haven't even looked at the higher time frame picture and the actual trend and where the true draw on liquidity in the market is going. So instead of just guessing, here's actually how to stay in control of your trades. What I want you to first understand is that everything is reverse engineered around your draw on liquidity. So first, come into the day with a plan. Come into the day marking out your higher time frame draws on liquidity on the 15-minute time frame and above, and mark out clear highs, clear lows, and see if we are disrespecting fair value gaps or respecting fair value gaps. A simple way of knowing where truly the draw on liquidity is and where the market is heading is just asking yourself these two questions. One is, where are we delivering? Is it from sell side or buy side liquidity? The next question is, what fair value gaps are we respecting versus disrespecting? So if we are delivering from sell side liquidity and we are disrespecting bearish fair value gaps, then the draw on liquidity is most likely higher towards whatever that next swing high is. Or let's say we are delivering from buy side liquidity and we are displacing lower and we are disrespecting bullish fair value gaps, then our draw on liquidity is most likely lower towards that next swing low. So once you now understand where the higher time frame draw on liquidity is, go down now on the lower time frame and wait for your entry model to present itself and make sure it is aligned with that draw on liquidity. And to actually stay locked in, you need to be blocking out all of that noise. And the way to do that is lesson number 4, to ignore lower time frame SMTs unless they are at your draw on liquidity. SMTs is by far one of the most powerful ICT concepts there is, but it is very oftentimes misused. They're meant to reveal manipulation in the markets, but if you use every single SMT as a reason to enter, you end up just reacting to the noise instead of the actual structure of the market. Now, I see this all the time with beginner traders. They'll see a little 1-minute SMT form, not inside of any key level, but just at a random swing low, and then they think that the direction of the market is now changed. I've also seen many beginner traders take a trade on the lower time frame, and then I see them close early at some lower time frame swing high or swing low that is not at their draw on liquidity or intended target. And this just kills your risk to reward and your overall conviction in the setup. So here's what I started doing instead to get consistent results trading with these SMTs. For one, only focus on SMTs that are actually at your targets or at your intended draw on liquidity, and look specifically on the 15-minute time frame and above. I do not want you zooming into the 1-minute and the 30-second because that is just way too much noise. Zoom out and look at the overall picture and look where true manipulation is happening, which leads me to my next point. You should be expecting SMTs to form. You should be having already your key levels set up, and the SMT should just be that added confluence within that setup, and it should be with your bias and your intended overall draw on liquidity. And let's say you're in a trade and an SMT forms at your target. You want to move your stop loss either to break even, or if you're above a 1-to-1 risk to reward, I like to just take my profits there, because if we truly have completed the model that we are in, whether it's a buy model or a sell model, and we are now starting it back to the opposite direction, then that SMT is probably going to be valid and you're probably going to get stopped at break even. So it's always great to be securing profits once you see that SMT form. And finally, my last tip is that even if you see this SMT at your target, don't immediately just flip buys just because an SMT forms. Again, SMTs are happening all the time. The ES and NQ assets are not always going to be perfectly correlated to the T. So be patient, and if you see that SMT form, wait for proper distribution in the opposite direction to really confirm that your bias is right and that the SMT is then valid. Now, we've covered the majority of the chart work, but I want to now talk about how to actually anchor your mindset and get you ready for the trading day. Which brings me to lesson 5, which is to wake up early and write out your bias. If you want to have an edge over everyone else and start earning like the top 1%, then you have to start acting like the top 1%. Understand that they're not always showing you that lifestyle behind the scenes. Now, of course, you guys see me all the time traveling to different places and doing what I want with my life, but no one really talks about it, that you need to be treating trading like a real job. You cannot wake up 1 minute before market open and trade on your phone in bed and expecting to have a good trading day. You need to be waking up early and actually writing out a game plan. So what I do every single day is I'll probably wake up around 1 to 2 hours before market opens, and I'll be on the charts at least 15 minutes before the session starts. And from here, I can write out a daily bias coming into the day. And I'll give you an example on one of the daily biases that I have in my journal. So already I'm coming into this day with a framework on the higher time frame that we are bullish. So if we get this 15-minute and hourly change in state delivery, we can expect London highs and that recent buy side. And as for internal liquidity pools, we have data highs as an obvious draw coming into the AM that I would want to see get hit. And as you can see, this play out perfectly. After sweeping out previous day low, we did get that change in state delivery. We got clear displacement higher, and we did end up running towards that buy side liquidity. So that was an example example of a really obvious bias on the day, right? Where I was very clearly bullish and I was going to take longs. But if you come into the day without a game plan and without a bias, you're going to be taking trades against the higher time frame draw, and you're going to be really, really confused. And you're going to think one 1 minute candle means that we are bearish if it's going down, or one 1 minute candle to the upside means that we're bullish, when that is not the case, and you need to be zooming out. There's also days, of course, where I don't have a bias and I can be neutral and I just want to see what the market is presenting to me. So here I said neutral bias coming in the morning, range bound conditions, 4 hours still in a sell model. So I'll be leaning more bearish to see if 930 can Judas higher towards previous day high and towards that daily for value gap. The 1 hour is the current condition. So if it's respected, we should see previous day high, but if it's disrespected, we should see the relative equal lows. And lots of news to be cautious, right? So this is my condition, this 1 hour for value gap here. If it's respected, then we should go higher towards this daily for value gap and towards previous day high. If it is disrespected and we start displacing through it, then what should price do? We should trade lower. And as you can see, we had a 930 open low into this 1 hour for value gap, and then price traded higher towards that daily for value gap. And I remember taking longs on this day towards that daily for value gap because I had this game plan set out beforehand. Now, on top of writing out your actual scenario every morning, after your trading day, you also need to be journaling. And I know everyone talks about it, and me personally, when I first started trading, I was like, I don't need a journal, it's not necessary. But if I literally just started journaling, I would have progressed so much faster as a trader, because I'm telling you, your win rate automatically improves when you start journaling. So take a screenshot of your trade, write down exactly what you did right, what you did wrong, and what you can improve on going into the next day. And doing these two things, journaling after my trades and journaling before I take a trade, is what built me so much confidence in my model and what improved my win rate by so much. Now, there's also a way to actually build confidence with your strategy without risking capital. But this leads me to my last lesson, which is that the more you know, the worse off you are going to be. Now, don't get me wrong. Of course, you should master your craft before, because knowledge is really power when it comes to trading. But what most people get wrong is that they overcomplicate ICT concepts like crazy. They learn every single concept that ICT has to offer, but that is not what ICT trading is about. It's about learning just the core concepts and really applying and creating your strategy around that. So here are the 3 core concepts and the only concepts that you really need with ICT trading. 1 being liquidity, 2 being fair value gaps, and 3 being market structure. All of which I've broken down in a bootcamp series on the PB Trading YouTube channel. But I'm telling you, if you just really focus on these concepts and create a model around that and not focus on random propulsion blocks, rejection blocks, all these other random concepts that you don't honestly need, and really just simplify it, your trading will become so much better and so much more consistent, because every high probability trade follows these 3 things. There's a liquidity sweep that's usually aligned with a fair value gap. You then see price disrespect a fair value gap going in your direction. You then see price disrespect a fair value gap, which is where your entry comes in play, and then you target the next liquidity level, or unfilled fair value gap, which I teach with my mech model. And if you can just drill this in your head and practice this every single day, you will start executing with real confidence. So now you have the exact blueprint that took me to $1 million in trading by the time I turned 21. But if you just watch this video and you don't actually apply this concept, I'm telling you, nothing will change. So go back in here, take notes, and actually apply the concepts every single day. Make it a priority to yourself to apply it. And if you want a more personalized approach where you can actually learn the exact strategies that have converted some students from making $0 to actually seeing some profits with their trading, students like Leo here getting his first payout after only being in the 1% mentorship for 2 months, or students like Safai who's made over $27,000 in payouts since joining the 1%, then click the first link in the description to get started right away. And thank you guys so much for watching this video. Peace out.